In 2018, Tesla, the electric vehicle and clean energy giant, made an unprecedented move, proposing a $56 billion compensation package for its CEO, Elon Musk. This audacious pay plan, directly tied to Tesla's market capitalization and operational milestones, sent shockwaves through corporate America. The sheer magnitude of the potential payout ignited fierce debate, raising fundamental questions about executive compensation, shareholder value, and corporate governance. At the heart of the controversy was the question of whether such a colossal reward was justified, even for a visionary entrepreneur like Musk. Supporters argued that the package incentivized Musk to achieve extraordinary goals, propelling Tesla to the forefront of the electric vehicle revolution. Critics, however, viewed it as excessive and unaligned with the interests of ordinary shareholders. The controversy highlighted the growing disparity between CEO pay and that of average workers, sparking a broader conversation about income inequality and corporate accountability. As Tesla's stock soared in the years following the proposal, so too did the potential value of Musk's compensation package, intensifying scrutiny and raising the stakes for all involved. Glass Lewis, a leading proxy advisory firm, recommended that Tesla shareholders vote against the proposed pay package. Their opposition stemmed from concerns about potential dilution of shareholder value and the lack of independent oversight in structuring the deal. Glass Lewis argued that the sheer size of the package could significantly dilute existing shareholders' equity, potentially diminishing their long-term returns. Furthermore, they expressed reservations about the performance metrics tied to Musk's compensation. The targets, heavily reliant on Tesla's market capitalization, could incentivize risky decision-making aimed at inflating the company's stock price, even at the expense of sustainable growth and profitability. Glass Lewis also raised red flags about the potential for conflicts of interest, given Musk's involvement in multiple ventures, including SpaceX and the Boring Company. They argued that his divided attention and commitment could detract from his focus on Tesla and potentially harm shareholder interests. Their opposition underscored the importance of independent board oversight and shareholder engagement in matters of executive compensation. The controversy surrounding Musk's pay package took a new turn when a shareholder lawsuit, filed in Delaware Chancery Court, challenged the deal's legitimacy. The lawsuit alleged that the Tesla board had breached its fiduciary duty by approving such a massive and potentially dilutive compensation plan. The court ultimately ruled in favor of Tesla, upholding the board's decision and dismissing claims of a breach of duty. However, the legal battle and mounting scrutiny surrounding Tesla's governance practices appeared to contribute to Musk's decision to relocate the company's headquarters from California to Texas. Musk cited Texas's business-friendly environment and lower cost of living as factors in the move. The relocation to Texas, a state known for its limited regulation and less stringent corporate governance standards, further fueled concerns about shareholder rights and corporate accountability. Critics viewed the move as an attempt to evade scrutiny and operate with greater autonomy. The Delaware court's ruling and the subsequent move to Texas highlighted the complex interplay between corporate law, shareholder activism, and CEO influence. Despite the controversy and opposition from some proxy advisory firms, Tesla shareholders ultimately voted to approve Musk's $56 billion compensation package. The vote, while not unanimous, demonstrated the faith that many investors placed in Musk's leadership and his ability to deliver on Tesla's ambitious goals. Shareholders who supported the package argued that Musk's track record of innovation and disruption justified the unconventional reward. They pointed to his success in transforming Tesla from a niche electric car maker into a global leader in sustainable energy and transportation. Moreover, they believed that aligning Musk's compensation with Tesla's long-term performance was in their best interest. The vote highlighted the complex relationship between shareholders and visionary founders, particularly in companies with disruptive potential. It also underscored the increasing willingness of investors to embrace unconventional compensation structures, especially when tied to ambitious performance targets. The controversy surrounding Elon Musk's $56 billion pay package at Tesla has far-reaching implications for corporate governance and the ongoing debate about executive compensation. It raises fundamental questions about the role of shareholders, the responsibilities of boards of directors, and the balance between rewarding success and ensuring corporate accountability. The case highlights the growing scrutiny of CEO pay, particularly in an era of increasing income inequality and heightened awareness of corporate social responsibility. It underscores the need for greater transparency and accountability in executive compensation practices, as well as the importance of aligning CEO pay with long-term shareholder value creation. Furthermore, the Tesla saga has reignited the debate about the role of activist investors and proxy advisory firms in shaping corporate governance. It also highlights the challenges of balancing the interests of various stakeholders, including shareholders, employees, and the broader community. As companies navigate an increasingly complex and interconnected world, the lessons learned from the Musk compensation controversy will continue to shape the future of corporate governance and executive pay.